Welcome to Illuminati Silver. We tell the truth about silver. Today is Tuesday, the 31st of October 2023, and we are taking a slight deviation from our normal speaking about gold and silver and talking about house prices and how, in the Western world, they are falling from their recent peaks. Now, this in itself may not seem too alarming, save for the fact that if we are going to have interest rates at an elevated level for longer, we could indeed see a housing crash, or certainly, more likely, a crisis. This does have relevance because, of course, people who've traditionally been investing in property may now, and probably should, though we don't give advice, be considering alternative investment asset classes until the property market has bottomed out. And this is where, perhaps to some degree, gold and silver can actually benefit. So we're going to take a look at what is happening in the housing market generally. And this is a repeat of a video we produced in Finances Do Matter a few days ago. It's still relevant to this channel though, because all of these varying asset classes compete with one another for investors' funds. On that note, let's take a look. In the past few months, I've produced a number of videos advising people not to invest in property, and particularly in commercial property, but also really not in residential property. Why? Because interest rates have been rising in the United States, in Europe, and in the United Kingdom, and therefore any rise in interest rates generally result in a decline in property prices, particularly if those prices have risen strongly before interest rates have begun to rise, which has more or less been the case. In the United Kingdom, for example, we've seen the base rate go from 0.5% to over 5%, and yet we have a scenario whereby people who perhaps had a mortgage rate fixed at or around 2% are now finding themselves paying 6 or even 7% for that same mortgage today when that fixed term comes to an end. So you're looking at 3 times, and in some cases 4 times, the interest rate repayment. The United States is no different, and we've recently seen in publications that mortgage rates are touching 8%, with the Fed funds rate at around 5.5%, and we would argue it needs to go up another 0.25%. But that's probably not going to happen, even though the Federal Reserve is meeting on Wednesday of this week. Nevertheless, people are finding it more and more difficult to be able to afford the mortgages that they already have, and increasingly difficult to obtain new mortgages for properties that they have to buy because for personal or business reasons they need to move home. This is rather concerning and is going to have a regressive effect on house prices, which we in the UK have already seen come down certainly around between 5 and 10% from their previous peak, and I would argue will continue to fall for some time yet. The United States, depending of course which state you're in, and the individual economies of those states, but nevertheless they've been seeing similar falls, and in some cases even higher ones. So let's take a quick look at a Bloomberg article published a couple of days ago in order to assess what the current situation is like. Mortgage rates at 8% make a brutal US housing market even worse. Surging US mortgage rates are delivering a stark warning to would-be buyers. A brutal market is getting even more challenging. Over the past 2 months, rates for 30-year mortgages have hurtled towards 8% by most measures. Affordability pressures are cutting into sales, with purchases of previously owned homes in September dropping to the lowest level since 2010, according to the National Association of Realtors. It's been a tough slog for house hunters since the start of the pandemic. After lockdowns started to lift, fierce competition fueled bidding wars and massive price increases. Then came rising rates that sidelined potential buyers, while owners also became more reluctant to sell. Inventory plunged, keeping prices elevated. These days, the few buyers that are still hunting are fighting over scraps. and the move higher in rates is making it worse. Applications for purchase loans have fallen to the lowest level since 1995. Contracts to buy homes were cancelled in September at the highest rate in almost a year. Even builders who have benefited from the tight supply of resale homes are becoming more concerned about the outlook. It's not just the sticker shock or psychological effect of a round number like 8%, said Greg McBride, chief financial analyst at Bankrate. But the rise in the mortgage rates from the lows at the end of 21 have robbed would-be home buyers of 40% of their borrowing power. That's monumental, and we've just never seen anything like this before. There's still a lot of pent-up demand for housing, and some people with money for down payments are trying to make it work. A measure of contracts to buy pre-owned homes unexpectedly increased in September from a month earlier, although it's hovering near the lowest level on record. Sales of newly built properties rose in September, but builders are expressing more caution. Nearly one-third of companies say that demand is slower than expected and causing concern. And here we can see a sign. About a third of US home builders worry about the appetite for new homes. And this is the level of concern rising to over 30%. Typically, sales start to slow during the time of year, but the market's seasonal patterns are being compounded by the financial and the mental threshold of interest rates rising. What has evolved is plain old affordability. There are not many people who have seen their incomes go up enough to match the fact that we continue to see prices go up and interest rates go up. The market's been so tight over the past year that buyers who are able to cope with higher rates or those paying cash are seeing this pullback as an opportunity. From 6.5% to 8%, there have been some that have slowed down, but those who are serious lookers are still looking. And if we take a quick look at an article published by the BBC just 4 days ago, UK house prices to fall until 2025, predict Lloyds. The UK largest mortgage lender expects house prices to fall this year and next before rising in 2025. Halifax owner Lloyds Banking Group predicts prices will drop 4.7% this year and by a further 2.4% in 2024 before recovering. Lenders have blamed higher borrowing costs for a slowdown in house sales. But the average house price remains about £40,000 higher than the height of COVID, when prices soared as people working from home sought more space. Lloyd said on Wednesday that while prices would fall over the next 2 years, longer-term growth would be steady, with prices rising 0.6% by 2027. Interest rates are currently at 5.25%, their highest level for 15 years, driven by a series of rate rises aimed at tackling soaring consumer prices. As a result, lenders have raised their borrowing rates, including for mortgages. The latest figures show the average rate on 2-year fixed rate is 6.24% on average, according to financial information service Money Facts. Well, as you can see, it's rather concerning. And there's no respite yet. And with the Federal Reserve saying in the United States, or the Federal Reserve Chairman saying that rates will be high for longer than originally anticipated, this pain will continue. And I would argue well into 2024, and perhaps it could be only in 2025 we may see interest rates starting to decline, though my suspicion and from my own calculations so far suggest that we may see an interest rate decrease towards the last quarter of 2024. But whether I'm right or wrong, regardless, now is still arguably not the time to buy houses. And certainly I would argue no time is the right time to buy commercial property in the next 2 years or so. However, I could be wrong. Let me know what you think. Thank you for listening. Appreciate it. If you like this video, you give it a thumbs up, you subscribe to the channel, and press the bell sign so you're notified of our videos as and when they are published. Meanwhile, stay safe, stay prosperous. Until our next video. Don't forget, Wednesday, Federal Reserve announcement on interest rates.